All right, let's pull back the curtain on a topic that usually gets stuck in the accounting department, but is actually one of the most powerful strategic tools a manager has: inventory. Because the value you put on your stock, that's not just a number. It's a decision that literally writes the financial story of your entire company. So, let's find out what your inventory is really saying. So, let's just start right there with that big question. When you look at an inventory figure, what is it really telling you? Is it just a boring list of unsold products gathering dust? Or is it something more, like a narrative about your company's stability, its efficiency, and yeah, even its chances for future growth? That's the real story, kind of hidden between the lines of the spreadsheet. And you know, this story doesn't just happen in a vacuum. It actually unfolds on two very specific stages: the company's main financial statements. I want you to think of the balance sheet and the income statement not as some dusty old documents, but as the two acts of a play that reveals pretty much everything about your company's performance. Okay, before we get any deeper, let's make sure we're all on the same page with our main term here: inventory valuation. All it is really is putting a price tag on everything sitting in your warehouse. It sounds simple, right? But the number you choose has this massive ripple effect that shapes how everyone, from your investors all the way to your own leadership team, sees your company's financial health.
Now this is where it gets really interesting. Your inventory is kind of like a master actor, playing two totally different roles depending on the stage. On the balance sheet, it's an asset. It's a snapshot of value that says, hey, here's what we own at this exact moment. But the second you sell an item, poof, it transforms. It walks onto the income statement stage and becomes an expense, what we call the cost of goods sold. It tells the story of your profitability over time. Same stuff, two completely different financial characters.
So let's dive into Act 1, how inventory valuation really shapes the balance sheet. This is all about perception. It's about how your company's strength and stability look to the outside world at one single point in time.
So, rule number one for inventory on the balance sheet: it's a current asset. That's just a bit of accounting speak for stuff we think we can turn into cash within a year. And that one simple classification, oh yeah, it carries some serious strategic weight.
And you can see that ripple effect right here. See, the value you pick for your inventory, it directly pumps up or shrinks your total current assets. That number then shapes your company's reported liquidity, its ability to pay the bills on time. And it's a key ingredient in the working capital calculation, which is like a vital sign of your company's operational health that banks and investors watch like a hawk. So this is way more than just bookkeeping. It's strategic financial signaling.
All right, time for Act 2. We're going to follow the inventory over to the income statement. This is where inventory stops being about what you own and starts being about what you earn. This is where we see the direct, undeniable link between a number on a page and the actual money in the bank. And here's exactly how that works. It's a powerful chain reaction. It all kicks off with that valuation choice we talked about. When you sell an item, its value literally jumps off the balance sheet and becomes the cost of goods sold, or COGS, on your income statement. And since COGS is one of the biggest expenses you subtract from your revenue, it has a direct, massive impact on your net income, your bottom line profit.
And this right here, this is the danger zone for managers. A small, seemingly innocent tweak in how you value your inventory can create this weird funhouse mirror effect on your company's profits. Just imagine you value your inventory a little too high. Suddenly your costs look lower, your profits look fatter, and you might start making huge decisions, like expanding or hiring more people, based on what is basically a financial fantasy. It's a trap, and it's baited with good news.
Which brings us to our final and maybe most critical act, the director's cut. Because look, if you're a manager, you are the director of this entire financial story. You have to understand how these pieces fit together, because every single strategic call you make is being influenced by these very numbers.
And if those numbers are messed up, the consequences can be absolutely devastating. A sound strategy is always built on a foundation of accurate data. But if you're operating based on fake profitability, you start making poor investments. You start chasing growth that isn't even real. And eventually, when the math doesn't add up, investors and lenders lose faith. And believe me, that confidence is incredibly hard to win back.
So if you take just one thing away from all this, let it be this thought. That number on your inventory report is not some passive fact that an accountant just writes down. No, it is an active, strategic choice that a manager makes. It's a choice that shapes perception, drives decisions, and ultimately defines your company's financial story. So the real question is, what story do you want yours to tell?